Hello and welcome to the CNBC TV 18 Global Dialogues. The Infosys stock has seen a 90% up move since Salil Parekh took over in 2018. The company has been the best performing tech stock with a 50% gain and is likely to report industry-leading growth this quarter at 2 to 3% of revenues. Further, Infosys has also turned carbon neutral 30 years ahead of the 2050, the timeline that was set by the Paris Agreement. In more news, the company has completed the acquisition of award-winning digital customer experience, commerce and analytics company, Blue Acorn. Salil Parekh, the Managing Director and CEO of Infosys, joins me now to talk numbers and strategy. Salil, always a pleasure. Many thanks for joining us here on Global Dialogues. Let me start by asking you about the transformation strategy that you had put in place when you joined the company almost 3 years back in 2018 in January, Salil. The focus then was on winning large deals, on becoming more relevant in the digital space and skilling employees, as well as further efforts to localize. Now, you've been able to achieve good metrics on each of those parameters that you had set out. So as you start your fresh year, is there going to be a new strategy? Will you do a little bit of the same? Will it be something different? Are you going to sharpen and refine the current strategy? What should we now expect?
So thanks, Shereen, for having me. I think absolutely we've had many of those areas, digital, reskilling, focus on what we do with our employees, all of that working well. Our focus today going ahead is really continuing with where we are. We'll close out the third year in March, and at that stage, we'll start to look at what could be the further refinement. What we are really seeing is much more work on digital transformation. As you know, we reported 25% growth in digital in the previous quarter, and we see that traction continuing. About half of our companies now focused on digital, and we're seeing more and more work in the cloud space. We launched our own cloud brand, Infosys Cobalt, a few weeks ago. So that should continue, and much more refinement in that direction.
Okay, much more refinement in your transformation strategy, and you hope to be able to put that out in March when you complete the 3 years. But Salil, on the digital front, because when you posted your numbers, you did talk about 50% of revenues coming from the digital business soon. Can you quantify that for us? What is the timeline that we're looking at?
Soon, really, Shereen, it means in the next few quarters, because we've been growing at this very good pace of 25% for some time, even through this whole crisis environment with the global economies in a difficult situation. Our growth in digital is continued, because the focus for many large enterprises is really to adopt digital and drive it through. So really in the next few quarters, we hope to see us crossing over to the 50%.
Okay, next few quarters crossing over the 50% in terms of digital revenue. Salil, what we are seeing today is a resurgence of cases across the US and Europe when it comes to COVID. Is that a concern? Are you starting to hear nervousness from clients already on the back of that?
So today, Shereen, we are seeing that the cases are increasing. The model that we built, the scenarios we built, had anticipated some of that to come about. And our growth guidance, which is 2 to 3%, bakes in some of that. Of course, if there's an extreme scenario, we've not baked it in, but we don't see that coming today. And we don't see at this stage any nervousness from our clients, especially on the digital portfolios.
Okay, so at this point in time, holding on to the guidance that you've given out, I want to talk a little bit about what we are now starting to see in a post-COVID era, Salil. When I spoke with Rajesh Gopinathan, he said that we're at the start of a first phase of a multi-year tech transformation cycle. How are you reading that? And what is this going to mean structurally for each of your businesses going forward? What is it going to mean in terms of spends as well that you foresee?
So there, the technology world is really going through a massive change, and any large enterprise is leveraging technology for different uses. So you look at businesses, whether in retail, in banking, in insurance, everyone's leveraging technology to make sure that they're connected with their consumers, their customers in a direct way, in a digital way. All of that is a benefit for us at Infosys, because the more there's a focus on these digital technologies, the more we see a growth in the coming years. once we get beyond the COVID situation, my senses will come back to where we were as we entered it. We are at a very good growth pace of 9.8%. My senses will start to come back to that. And now this wave has further accelerated. And in that, we will see more and more of it in the years to come.
Okay, so if you believe that once we have dealt with COVID in the best way possible and the uncertainty starts to ebb, that we could go back to pre-COVID kind of growth. But, FY22 and beyond, Salil, given the fact that we are talking about this great digital acceleration and the capabilities that you've been able to define over the last few quarters, what will that mean? I mean, when are we talking about double-digit growth, for instance, for you as well as for the industry?
So there, with respect to the industry, difficult to say, Shereen, but I think in terms of where our focus is, we start to see that more and more of those sorts of activities, whether it's in the data space, whether it's in the cloud space, whether it's the Internet of Things, whether it's artificial intelligence, those investments, if they're right and appropriate, and we believe they are for what we've done, those will see us give good returns in terms of our growth. These are the sorts of things that large enterprises and clients are really working on today. And we believe that because of what we've put together, we are quite close to them in helping them on that journey. And so once we are beyond the COVID environment, we'll start to see more of that relevance with our clients coming to show.
When we talk about this relevance with clients and you talk about spending as well, and the focus has been on driving those large transformation deals. Now, how are clients funding those deals? Is a lot of the legacy business being cannibalized in order to fund the new transformation deals? And what is the outlook then in terms of spending? Are you likely to see a significant change in spending patterns, quantum, size?
So there, many large enterprises are doing much more efficiency on their traditional spend, much more automation. And that's another one of the tenets that we've built very aggressively. It's a historical strength of Infosys, and we have further expanded upon it. That automation approach allows large enterprises to make their traditional spend more efficient, and part of that is used to drive the digital growth. Now, what that does also is allow them the acceleration they're seeking. As they see more growth, they tend to invest more in the digital spend. And that's the approach we think will further be cemented once we get beyond the immediate crisis.
Mm-hmm. So, since we're talking about big deals and we're talking about staying relevant to clients, Salil, this has been a big focus area for you. We've seen the Vanguard deal go through in this quarter. Is it going to be increasingly harder and challenging to get those kind of deals, given the landscape, both competitive as well as the uncertain environment? Or do you believe that you are now poised to be able to do much more of that kind of transaction?
So those sort of large deals or large partnerships, Shereen, are ones which are in our pipeline. But as I've shared in the past, those are more volatile because of the size. So in a given quarter, it's difficult to predict what it will look like. But if you take a full year, we think we have a good pipeline, a good set of connects with our clients that we will continue to deliver on the large deal expansion across a longer period like 4 quarters.
Okay, so a little more color on this pipeline that you spoke of, since you feel confident of being able to execute on them over the next few quarters. If you can shed a little more light on this pipeline of large deals that you just spoke to me about.
So there, what really stands out is where large enterprises are looking to make digital transformation in a particular area, one part of their business, the mainstay of the transformation. And here you see 2 types of businesses. One, businesses which have actually been very early adopters, and they're seeing tremendous benefit in this difficult economic environment. And they're thinking, why don't we go faster in the other areas of the business? And there's another business which was slower to start with, and they want to catch up and accelerate even further. So those are the sorts of things that we are seeing in the pipeline. It's spread out across different industries at this stage. So there's not any one industry that's concentrating it.
Okay. Salil, let me ask you about the margin outlook and the margin guidance as well. FY21 EBIT margin guidance of between 23 to 24%. Do you believe that this is sustainable? Do you believe that this is the peak? Or do you believe that you could, in fact, better on it?
So that guidance we've given for this financial year, we had an extremely strong quarter at 25%, over 25% operating margin in Q2. One of the things we'd seen at the start of the financial year was we had put in a lot of care in what we were spending on and really being very disciplined about expenses. Of course, travel itself has come down quite significantly given the medical situation. Some of those things will start to come back, but what will remain is our commitment and focus on being a high margin business, and those sorts of things will go on. We have many levers that we identified, for example, the mix between on-site and offshore, the way we want to look at subcontractors, how we want to deal with expenses. Those levers will benefit us in the quarters ahead, but we've not given a guidance for the next financial year at this stage.
Given the fact that some of these levers that you just spoke to us about, is there a possibility of doing better, or is there a downside risk, or do you believe that you'll be able to hold the guidance that you currently have, especially with some of the concerns on the visa front and the visa costs front? How is that going to be baked in?
So there, specifically on what's going on with the visa situation, some years ago, we started to build out what we call local digital centers in Europe, US, and in Australia, where we have a large business. Those centers are helping us specifically in the US. We're also doing recruitment from colleges in the US and recruitment at lateral levels. So we want to make sure that our business model becomes more resilient, even as some of these regulations may change over time. With respect to margin, I think our approach really is we have some levers that can benefit us. Equally, there are some situations, for example, travel, which was very low, which will come back. And so we remain committed to being a high margin business, but we don't have a guidance for the next year.
You talked about offshoring as well as localization. Do you believe that given where we find ourselves today with COVID and perhaps the previous hesitation of having to move stuff offshore, do you believe that we're now going to see a bigger pickup in momentum when it comes to offshoring?
Well, what's clear there, Shereen, is I think, again, large enterprises have realized that offshore environments working remotely is working quite efficiently. So what this will do, but this is more medium term, is it'll really open up much larger areas where we can do remote work. And once the concept of remote work is internalized, the location then becomes the second point. And I think that will definitely benefit what we want to put in place in front of our clients.
Mm-hmm. Salil, let's talk a little bit also now in terms of the announcement that you've made with respect to the ESG metrics. And of course, this seems to be the big buzzword. I was just having a conversation with Brian Moynihan at Bank of America, and they're driving this along with the World Economic Forum as well. Do you believe that this is going to matter from an investment point of view, from a client perspective? Are they going to look at companies differently and use the ESG lens at all when it comes to dealing with people like you?
So on ESG, Shereen, first, we are extremely proud that we are carbon neutral here in 2020, so we're delighted. This work was started years ago at Infosys, and especially with the leadership of all the founders and many, many people within the company. And that's a big achievement for us. We've now set goals for 2030, And we've set goals in each of the three areas: environment, social, and governance. Our view is, while we are focused on our employees, our clients, our shareholders, we also want to make sure we keep our attention to what's going on in the world at large. And this is from that perspective, and historically it's been something Infosys has always thought about. Now, in terms of what clients will look at and what investors will look at, I don't know specifically, but I know that there's clearly an interest from within the company to do this. And I know that what you mentioned, for example, with what Brian is doing or the World Economic Forum, there's an external interest. So we hope those two will align and give us some benefits.
Well, that certainly will be the hope. But Salil, acquisitions, because that has also been part of your strategy over the last 3 years. What next and where next? What will the focus areas be now specific to acquisitions?
So in acquisitions, we've done quite well in the past few months. We've had 3 very strong acquisitions. One where we partnered with new technologies and ServiceNow, another with Adobe, another with Salesforce. These are all in what we've defined as our digital footprint. And we think this is something that will continue. Again, here we have a good pipeline of potential acquisitions that will continue. And the location, we've done some in Europe and some in the US, and that's generally what will continue as we look ahead.
So is it likely to be the same track that you are going to follow, a bunch of acquisitions through the year, 3 or 4? Is that fair to assume?
So the thinking for us is there's no specific number, but we definitely have a view that we will do a number of these in a 12-month cycle again. It so happened that all 3 of these came in the past 3.5 months or so. But in general, across a year, there'll be multiple acquisitions. There are many factors which have to be satisfied. So there's no specific target on a number of acquisitions.
There might not be a specific target in the number of acquisitions, I understand, but what is the war chest that you're working with? Because you're very clear that this will be part of the strategy to drive growth. So what's the kind of war chest that you've put aside to be able to conclude some of these transactions?
So there, we are really fortunate. First, we have over 4 billion in cash on our balance sheet. We have no debt. So, and we generate roughly 2 billion in cash a year. We have a commitment to return cash to shareholders, but beyond that, there's genuinely sufficient amount that we don't have a limit to what we can do. It's really more focused on what we can integrate, what will make sense in terms of the digital footprint we have, and how is the culture of the 2 companies, what is the pricing. So there's no specific, even internally, watches, but there's an openness to look at different ideas.
Okay, and openness to look at different ideas. But Salil, I want to go back to the deal pipeline that you spoke of. And if I were to take a look at the last 4 quarters, the average deal wins in the last 4 quarters at about 8.35 billion. Since you spoke about a robust deal pipeline going forward, can you give me some indication of what this number could look like?
So that's a good number. I think if it's 8 billion over the last 4 quarters, that's a good number in which for us to target over the next 4 quarters. But we don't have really guidance on that. But that's the sort of a number that has helped us over the last 4 quarters, and we hope to continue to do something like that as we go ahead.
Okay, so you hope to be able to replicate that 8 billion number as far as the deals are concerned in the next few quarters. But Salil, the key risks that you're going to be watching out for, COVID and the COVID-related uncertainty, of course, the big one. But outside of that, in specific vulnerabilities in specific sectors like retail, etc., what's looking softer today? What would you be most concerned about?
So there, what we started to see is our high-tech business is really doing extremely well, and we shared that just at our results time. We have good traction in financial services. We see that sectors like retail and manufacturing, which were initially impacted in the March-April timeframe, was steadily, especially retail, steadily starting to come back. We'll have to watch out now for how these new set of cases come about. But each month we'd seen a small, slow progression in that. And manufacturing, while a little bit behind on that, was also progressing each month. So that's how we're seeing the different industries today. But we'll keep a watch out as we go ahead and what the different industries mean.
Since you spoke about refining the transformation strategy, what will that mean, Salil, in terms of future investments? What will it mean in terms of hiring, both local as well as on-site? Just leave me with an indication of how that's expected to pan out.
So in terms of hiring, we have plans of recruiting approximately 15,000 college graduates in India, and approximately 1,500 college graduates outside India across multiple geographies. So this is over the next 12 months, so fairly robust hiring. In terms of the strategy, really our focus will be, once we get beyond the COVID situation, to have a real look and see where the next phase of transformation is. But in terms of investments, our plans are to drive all of that investment from our operating business. So not to have any new incremental investments which will impact our operating performance.
Well, Salil Parekh, always a pleasure. Here's wishing you the very best of luck. Thanks for sharing the outlook for Infosys on the Global Dialogues. With that, it is time for us to wrap up this edition of Global Dialogues. From all of us here, goodbye. Thanks for watching. 12 years ago, when the world was in the throes of a financial crisis, Bank of America was on the brink of bankruptcy. Today, it is healthy enough to post a $5 billion profit in the 3 months ending September. It has been profitable every quarter during the pandemic, even though the third quarter earnings missed the street's estimates marginally. CEO Brian Moynihan believes the worst could be over and a recovery is starting to take shape. He's also pledged not to cut the workforce this year, a decision that runs in stark contrast to the job cuts at rivals like Goldman Sachs, JP Morgan, Citi and Wells Fargo. Moynihan is also the driving force behind the ESG metrics, a new set of rules for global corporations to live by, a set of measures to enhance environmentally sustainable business performance with rigorous social and governance objectives. Joining me today to talk about the new guidelines for sustainable value creation as the world attempts to recover from the COVID pandemic and, of course, the future outlook for the global economy is the CEO of Bank of America, Brian Moynihan. Brian, always a pleasure. Many thanks for joining us here on CNBC TV 18. It's a pity that you couldn't join us here in India, but nevertheless, it's good to have you back on the channel virtually.
It's good to be with you again, and hope all of you are staying safe and making it through this healthcare crisis.
Well, we're trying our best, Brian. Let me ask you about what you make of the global recovery, Brian. Most CEOs that we are speaking to do seem to suggest that perhaps the worst is behind us, that the crisis has passed. Would you agree?
Yeah, I think if you think about the major economies of the world, whether it's the European economy, the Chinese economy, US economy, and then the other economies like the India economy, if you look at the economies that are on the furthest side of the healthcare crisis, because this is a healthcare crisis and that has an economic impact, you can see the China economy has basically grown through its downdraft and it's growing again and it's bigger than it was. And if you look at the US, our expectation from our experts this quarter is that you'll see 30% plus growth in GDP for the third quarter. So it's 33% down in the second quarter, 30% plus up in the third quarter, which leaves you about 95% of the size you were prior to the crisis, which is a big restoration of the economy. And then in Europe, likewise, you're starting to see it come back. But it's all going to be about the healthcare crisis. And you're seeing in literally today and yesterday, the concern as cases rise, will there be further measures to control and shut down? And that may make the recovery ebb and flow. But right now, we've restored a major part of the economies in the world.
Yes, we have seen a major part of the economy globally being restored, Brian. But, you spoke about this ebb and flow that is expected given the fact that we're now seeing a rise in COVID cases across the US and Europe. What's the worst case that's being factored in at this point in time? We are now starting to see local restrictions, lockdowns being reimposed. What's the worst case scenario that's being built in, factored in today?
Well, I think our economic experts, we have the #1 research team in the world, has the U.S. growing in the fourth quarter and then growing each of the quarters next year, and total growing 4.5% or so next year. And we have India down 9% in 20 and up 8%. So I think people are factoring in ebbs and flows. They're probably not factoring in a shutdown, a worldwide shutdown again. But you don't see that in government resolutions as you look at the economies across the U.S. are in different conditions. You're seeing that the ability to control, the hospitalizations and the serious outcomes because the treatment regimens are better, et cetera. And we're in a race for a vaccine, which is somewhere out there ahead of us. And so now the question is, what are you going to do between now and then? And I think the nature of the controls appears to be different, although we have to take this virus very seriously, wear masks, socially distance, and all those things. But I think the understanding of that is much deeper in the populations than it was in March and April. People forget we didn't understand how this was transmitted back then. So the shutdowns and the belief that you had to close public transportation, things like that are not the same right now.
Yes, there is a better understanding of how to cope with the virus. But, in terms of central bank as well as government intervention, Brian, and we've seen a whole bunch of stimulus packages being announced, not just in the US, but across the world. What's the expectation now, given where we find ourselves with global growth and specifically in the US? What next now in terms of intervention?
Well, I think you have to remember this is a healthcare crisis, and until the healthcare crisis is behind us, the human crisis that comes out of the healthcare crisis around the world is the issue. So the central governments around the world, including the Fed in the U.S. leading it, and governmental administrations around the world, including the administration in the U.S., basically in March, April, May, unloaded tremendous monetary stimulus and tremendous fiscal stimulus, which has had a strong offsetting effect. That's why you get this fast snap back to a high, 95% of the economic size in the U.S. immediately is because of what the public sector did through monetary stimulus, fiscal stimulus, and frankly, what the banking sector and others did to support their customers and clients through this, including extending loans and customer assistance programs. And so all that has worked. The issue now is it's gone on longer than people thought. And so now the question is, as you look across the range of industries, certain industries are back and the revenues are there. Certain industries fared well in this, whether people who do things around the home, supply goods that are consumed in the home improvement, things like that. Those things have done well. Certain industries have done fine or are back open, doctor's office, dentist's office, and things like that, law firms, accounting firms, et cetera. But other industries, the restaurants, the attendance venues, concert venues, bars, restaurants, universities, state and local governments, we need another stimulus in my mind to help those people make it to the other side of the crisis. It just is, it's much more tailored now, the need. Unemployment assistance for those that are still unemployed, small business assistance and another PPP package, but for those small businesses struggling, and then assistance to certain industries, airlines, cruise ships, movie theaters, things like that, if they want it, in order to keep those industries in shape that when the virus and healthcare crisis behind us, they can go right back to work. And so the focus can be more narrow, but you still need some help on both the human side and also an economic side to help those industries cross the river and get to the other side.
Right, so much more targeted approach is what you expect from the next set of stimulus measures. And that brings me to the expectation as far as the new administration in the US is concerned, whether we're going to see continuity or we're going to see change. Whatever it is, come the 3rd of November, what challenges do you foresee for the next US government to take forward?
Well, the United States has been through a lot of elections, and our company is 230 years old and been through most of them. So whatever happens, whatever the American people decide next week, the issues in front of either the current administration or new administration, whatever the people side, are the same, which is how do you make sure in the U.S. that you develop a targeted stimulus program to help those people still affected by the virus move forward, how you build the distribution regime for the virus vaccine, because it's going to be a lot of logistical work. These things are shipped extremely cold, have to go into people's arms right away in order to do it, and build the logistics behind that. And then longer term, you need to build an understanding of what you're going to do to not have to react the way we had to react to this one going forward. And that is a much more intricate, nuanced thought process, but that has to take place. So I think there's a near term, more stimulus, help people along, a intermediate term task on the healthcare crisis, which is to continue the treatment regimens and the PPE and all the stuff that we need, and get ready to distribute the vaccines that are coming along. And then the third element is, how do we make sure that we have a regime that can react faster than the last reaction could be in place, i.e. stockpiling major amounts of PPE and things like that. And groups of us are working on that.
Let me ask you specifically from a market's perspective, Brian, and the expectation is that if it were to be a Biden victory, then perhaps we could see a hike in taxes, especially a hike in taxes for the wealthy, etc. How much of that has been built in from a market standpoint, and what do you believe that could mean if it pans out that way?
Well, I think the market is reading the same polls that everyone else is, and I think there's a lot of, just the way the whole world works right around an election, it happens in your country, it happens in our country. There's a lot of discussion about what this all means and things like that. At the end of the day, there's been a lot of elections in the United States history. There'll be a set of policies that come out. The markets will react to them. But I think until they're on the table, it's a lot of speculation. So I think that the market is basically moving around on day-to-day based on the virus pathway right now more than it is on the election. And I think that's the notice for everybody, is we got to get this healthcare crisis behind us.
Yes, that certainly is the focus across the world. But let me ask you about India, Brian. And, the expectation here is, at this point in time, a contraction of 9.5% this year and a growth in the next year. The government is also putting in place measures to try and attract foreign direct investment, hoping to benefit from the shift out of China and hopefully to India. How are you reading the India story today in light of the geopolitical changes that we are seeing?
We have been very bullish on India as a company, both just in terms of operations and our team led by Kaku and the country, and the groups we have that support our worldwide businesses. So we're bullish on it. But if you look at it more from our economic and our analyst side, they believe the government's measures are right. They've got to get through the healthcare crisis just like every other country. But you've seen they're bullish on FDI. They're bullish on China plus one strategies, i.e. India becoming another place for companies to set up shop. I think the government has to continue its policies of liberalizing ownership and operations of foreign companies so that we can get more FDI coming in. But I think as a service provider, as a potential manufacturing venue, and the ability to drive those, our team is very bullish on India, and that's why they have it going back to 9% growth level next year off of the downdraft, as you said, this year.
So you continue to be bullish on India. Let me ask you about what you expect in terms of M&A activity going forward, Brian, not just in India, but globally as well. We've started to see a pickup in M&A, but what do you believe will be the drivers for M&A going forward?
Well, there are always going to be the classic drivers, whether it's, and so you saw some deals announced this week, which is consolidations for scale. There are companies which are struggling that people will try to go in and help them and rescue them through buying them and restructuring their debt and equity due to the over leverage with the downdraft in revenues. People buying capabilities to do other products. And so there's a healthy M&A practice going on. You're seeing it pick up. I think as the certainty of elections in the United States are behind us, and the virus path becomes even more certain, i.e. a vaccine, so people can have more assuredness in the economic projections, I think you'll see a pickup in activity as we move through this year into early next year. But it always depend on the stars aligning literally or figuratively, meaning that companies have to decide to do it. There has to be a buyer that decides they want to buy it, and then you have to get the deals done. So, but our team is seeing increased activity.
increased activity. Do you believe that India is going to be a center of this increased M&A activity? I mean, we've seen a significant number of deals go through with the Geo platforms, for instance, a company that you're familiar with. But outside of that, do you believe that in the renewable energy space, in the infrastructure space, the kind of private equity momentum that we've already seen over the last few years, do you expect that to continue?
I think what will continue is, India needs a lot of investment. It has a growing population, which makes it very dynamic. It has an incredible ability to provide services to the world. It's developing more manufacturing. It has a robust alternative energy. That's just going to take a lot of investment. So whether it's M&A or investments, there's, the investors we talk to still and continue to look at India as a great place to put money. And again, a lot of this is just ebbing and flowing with the view of how do I make sure, what is the impact of this healthcare crisis on any country. And so these are temporary elements, serious temporary elements, seriously human issues around them. But on the other hand, if you think about it in a grander scheme, the country's promise is still there now to draw a lot of investments and a lot of transactions.
What about raising capital? And that is something that we've seen through the course of this pandemic here in India as well as globally, companies trying to strengthen their balance sheet. And that's something that, Bank of America has been involved with as well from your client's perspective. Do you believe that that is something that we're likely to see continue happen?
Yeah, you're seeing continued capital raising go on to shore up balance sheets and restructures, which will continue. And also, a lot of money going into the SPACs and things like that. A lot of IPOs going through the markets because of investor demand and company opportunity, including, some behemoths have gone through. The equity capital markets is up significantly year over year at Bank of America. Matthew Coder and the team have done a great job of helping service their clients and handling those transactions. And we hit near record level, the second highest investment banking revenues in the third quarter, and the second quarter is the highest we ever had in the company. And both are driven not only by the fixed income market issuance, but also much more emerging equity capital markets issuance.
Yes, you certainly did have a good run there as far as the fee income was concerned. But Brian, let me ask you about something that I know that you're keenly focusing on, and that is this benchmark that's been put together where the World Economic Forum, Bank of America, PwC, EY, Deloitte have all come together to put a benchmark in place on measuring the ESG metrics. I know you've previously spoken about the need to focus on the 3 C's to ensure that these measurements are comprehensive, that they provide clarity, and that there is a degree of convergence. But explain to me what you hope this will do from here on.
Well, what you really hope it will do is define how stakeholder capitalism works, how stakeholder capitalism can be successful, and how you can bring the energy, innovation, and sizable capital expense bases, purchasing power of the private industry to help make the changes the world wants us to make. And so that you have to back up a little bit and say, where did this come from? Well, it's been a long-held view of the World Economic Forum. The ideas of stakeholder capitalism have been around for decades. The idea of the Business Roundtable in the United States moving to clarify that those companies believe in stakeholder capitalism. The International Business Council, which is a group of the large companies, including significant companies from India, declaring in 2017 that they would help drive the Sustainable Development Goals of the UN, which were developed in 15 by 190 countries. Those companies on the private sector would help drive the SDGs by how they operate their companies. A request and a statement by many of those companies saying we're going to carbon neutrality again to help on the environmental measures. And that all came together between ESG investors who want to find companies that do the right thing, between just a proliferation of standard setters with way too many focus on let's keep adding metrics as opposed to a standard set of metrics, and a need by the private companies to push the convergence, as you said, so that you can have a set of measures that you can measure by industry, the relevant competitors, and decide who is driving the SDGs, who is making progress, and then we can invest and help those companies go faster and further. And so all those things came together. Then the International Business Council with the big 4 accounting firms and the companies working there came up with a set of metrics, 21 metrics, matching the Sustainable Development Goals, and helping align capitalism to the SDGs, aligned capitalism, stakeholder capitalism. And it's the only way they'll get done because capitalism has the energy, innovation, and money to make these things happen.
Yes, I know you believe that that capitalism is the only way to address the world's big problems. Let me quickly ask you about the future of cash, especially in a post-COVID world. We have seen digital banking take off, contactless payments taking off, and that process has been accelerated on account of COVID as well. But cash continues to be king in many ways. What's the outlook? Because, you know, the obituary of cash has been written so often. Where do you see it in a post-COVID world?
Well, we are seeing a potential acceleration of trends that were already occurring. So you had a constant increase in digital foreign payments. At Bank of America, our consumer business is the largest in the United States by a good chunk in terms of banking. And if you look across those payment forms, all the different forms of ACH, wire, debit and credit cards, you know, cash out of the ATMs, checks written, Zelle payments, which is the P2P payment system the banking system has here in the United States, that'll be $2.5, $3 trillion a year. And cash is about 15, 20% of that. Every day, $200, $300, $400 million in cash go out of the ATMs. That has continued to be flat, and the number of transactions are going down, meaning people are taking more cash. And you've seen a rise in the rest of the transactions that now more than, I don't know, 55, 58% of all the transactions are digital. And that form will keep driving forward. And so cash's obituary has been written a lot. It's still important every day. You know, 300 million, 400 million, 200 million, depending on the day, of cash goes out of the ATMs into society. But on the other hand, the other forms are growing. So the Zelle payment product that the banking system put together, we've seen, you know, year-over-year growth in the 70, 80, 100%. It's now hitting record levels of transactions. It's moved up to be about 25% of the size of the payments of credit made by credit cards in the Bank of America customer base. So it's growing. It's got a lot of room to go. But the view is that we have to be able to handle both. We have to be able to handle cash needs and also do the electronification. And we are driving for that. It doesn't mean it's anonymous Bitcoin type currency. It means just digitizing cash as we know it today and having more ability for people to pay and use it and receive it, most importantly. And that's what Zelle is. And that's what the various forms that we're driving are. Apple Pay, Google Pay, mobile wallets, you pick it, but they're still a small part of the whole, although they're growing. And our job is to make sure we grow on both dimensions.
Mm-hmm. Since we're speaking about growth, you were talking about the growth of digital banking, but let me ask you about what the expectation now is as far as the bank is concerned. You missed estimates in the quarter gone by, but given the fact that you do expect a recovery and a restoration of growth, what's the outlook now for the bank? What's the outlook for hiring? And specifically, what's the outlook for expanding your business here in India?
Well, we earned $5 billion in the quarter, which was a strong performance, especially given that we're still in the middle of a crisis and interest rates. You know, we're sensitive to interest rates because we have $1.7 trillion of deposits, of which are all core deposits, and we do a great job with. So we're very pleased with the company's performance through the crisis. We built capital. We have more liquidity. We served our clients well. We had 2 million customer deferrals. We had the ability to do $70 billion of loans, $300 billion of deposit growth, you know, the number one franchise in consumer banking growing faster, wealth management franchise growing. The commercial loans are down because demand's down, and hopefully that's straightened out at this point. So we feel very good about the prospects of Bank of America, and we continue to way out earn our dividend and build capital at the same time. So it's a powerful machine and does a great job. In India, Kaka and the team just have to continue to drive the business in terms of capital markets, investment banking, commercial banking, and treasury services. We have high views of India. We continue to hire people in all these countries to serve more clients. We're an institutional business in India, and that's what we've done. And then we have our services group, which is a large number of employees that service the global franchise. But you know, we are very bullish on Kaku and the team, and we expect big things out of them.
Brian, before I let you go, you know, COVID, of course, is one of the key risks that global CEOs like yourself are going to have to deal with as we move forward. But outside of that, what would be the other key risks or the key challenges on your dashboard that you're going to be looking at closely?
Well, we always, you know, in the end of the day, banks transmit the economy for our clients and customers to the markets or to other clients and customers, depending on the businesses. And at the end of the day, we're going to follow the economy. And so we look carefully at what's affecting the economy. Obviously, the COVID crisis affected it. It's hopefully a temporary, although a couple-year impact by the time we get through it. And so that's number one. Then out of that is the question of whether the impacts of that become more permanent. So the unemployment rates in countries, went up measurably and now have come down, especially in the United States, fairly dramatically, but are elevated. And the question is, will that become a more permanent problem? And so we have to watch that, because that then turns into a real economic crisis separate from the healthcare crisis if we can't get the unemployment down and businesses restarted across the board. The third element, obviously, is we worry about cyber risk and things like that, especially around times of transition and times of elections and stuff. And we'll continue to do, Kathy Bassant and the team do a wonderful job of defending our company in that regard. We defend the trends of the risks of digitization and things like that, and competitors and new competitors and stuff we pay close attention to. So all the classic risks of market risk, market and trading risk, credit risk, reputational risk, these are all risks we monitor, and operational risk, operating from home with 200,000 teammates or 180-some thousand teammates operating from home, that just as unprecedented. The operational risk around that we manage very closely. These are all things that are out there, but it's the parade of things that keep you up at night are always the same, and they may be caused by different activities, but at the end of the day, when does it reflect in customers not being able to meet their obligations, or companies not being able to get the revenue and meet their obligations? That in the end of the day is going to affect the banking system, and we pay close attention to all those risk factors and try to figure out how to manage around them. But the number one thing is, through our responsible growth drive, you have seen us, earn, $13 billion so far this year, in, an economic twist of high order that was completely unexpected, build capital, build liquidity, and the team's done a great job for clients and customers. So we're very pleased with our ability to manage risk.
Well, Brian, always a pleasure. Appreciate you joining us here on the Global Dialogues. Thanks very much for your time, and we wish you the very best of luck going forward.
Thank you very much, and good to hear from you again. Stay safe.
Well, with that, it is time for us to wrap up this edition of the Global Dialogues. We'll see you again next week. Till then, from the entire team, goodbye and many thanks for watching.